Christopher Wood is equity strategist with CLSA, and he joins us to take some questions on his stance. Christopher Wood, thank you very much for joining us. Appreciate you being here. You've been a long-term bull for India. I mean, actually, ever since the current government took power, you've been overweight India. You've cut your weights in other countries that you look at, stocks from other countries, and added weight whenever you could have. Could you outline to our viewers what is the basic reason for that, and how overweight are you?
Well, actually, technically, it's not the most overweight relative to benchmark. Because in recent years, I've had a bigger overweight relative to a much smaller benchmark in the Philippines in terms of my Asian Pacific equity portfolio. But in terms of the actual weighting, in terms of percentage points, yes, India is my biggest overweight. I've had that big overweight prior to the last general election, and I've basically maintained it. But I would have to admit that in the last year, India has been better as a relative story than for its absolute merits, because the Indian market has been in an extended consolidation period following the sharp gains immediately prior and following the general election. So if there'd been some spectacular story in the rest of Asia to make a big weighting in, I would have done so in the last year, and I would do so today. But the reality is, on a relative basis, there's no dramatically superior story than India. So that's the major reason. I also think the worst case in the equity market is we would just continue to basically consolidate as opposed to collapse. So I'm not assuming the big downside in the Indian equity market. But the reason I'm not assuming huge upside this year is that we don't still see any real evidence or any clear evidence that a private sector investment cycle is about to kick off.
How are valuations for India vis-a-vis other emerging markets?
Well, no, India will underperform if we continue to get a rally in commodities and a weak dollar. So since the middle of February, when oil bottomed and global equities started rallying, we've had a bounce back from distressed levels in commodities and commodity-related stocks. So when you have a situation where commodities are rallying, particularly from distressed levels, you're going to get the classic commodity markets like Brazil, Russia, outperforming. But that's already happened. In my view, there's little reason for oil to rally more from where it was. To me, oil at $40, $45 is as high as it's going to get, and there's a risk of it correcting again. So personally, I'm going to stick with my big overweight in India. You're absolutely correct that foreigners are overweight India, but they're overweight India for the same reason I'm overweight India, which is there's a lack of, it's not clear there's vastly superior stories in the Asia or emerging market context. I'm not expecting big selling by foreigners. I'm not expecting big buying either.
Fair enough. As far as the US Fed is concerned, I mean, you've been one of the earliest proponents of the thesis that the next move from the Fed will not be a hike, but actually another round of quantitative easing. I mean, you've said it for a couple of years now, at least. Where do you stand on that one, Chris? What's your sense?
On that point, I'm not expecting. My view all year has been, my view at the start of the year was no rate hike by the Fed. Clearly, the view of the consensus, as well as of the Fed, was 100 basis points of rate hikes at the start of this year. I would say the consensus has now reduced their forecast from 100 basis point rate hikes to 50, but my own personal opinion is still, or my personal guess is still no rate hike. And in my view, before the end of the year, there's a significant possibility that we get renewed easing by the Fed. in the form of introduction of another form of unconventional monetary policy. As for the Indian interest rate policy, my guess or forecast, I'm assuming another 50 basis points of easing in India before the end of this calendar year.
In your latest Greed and Fear report, you say that investing in India also remains the most effective way of diversifying from China's risk, from the China risk. Could you explain that a little bit, and also what your outlook on China is specifically?
Well, yeah, because obviously most of these economies in Asia, the emerging markets, are more geared into China than India is. On China, I'm not expecting a hard landing in China, nor am I expecting a big devaluation of the currency. However, we had a big pickup in growth in the investment side of the Chinese economy in the first quarter, and we had a big surge in credit growth in China in the first quarter, which is another reason, apart from the oil rally, why the commodity-related commodity prices rallied, particularly iron ore, etc. But in my view, that you cannot extrapolate that big pickup in growth in China in the first quarter through the rest of the year. I think the Chinese authorities will now will not want to see a stronger credit growth this quarter as last quarter. So at the margin, I would expect a slight cooling in China. But fundamentally, I've got a neutral view on China in terms of the equity market. China's stocks are cheap, but they're cheap for a reason. More important for the rest of Asia and India is the Chinese currency. I'm not expecting a big devaluation in China, but the Chinese, in my view, are in the process of moving away from a dollar peg to tracking a trade-weighted basket. Many people at the beginning of this year were worried about a Chinese devaluation. They were worried that China was losing control of its capital accounts. And in my view, those concerns are exaggerated. The Chinese do not want to do a big devaluation because they're trying to promote consumption in their economy, and a big devaluation would reduce the purchasing power of Chinese consumers in dollar terms, and therefore make it harder to achieve their consumption-driven goals. And the second point on China is China's gross share of global exports continues to rise. So the Chinese problem on exports is not the lack of competitiveness, it's weak demand globally. So I think as for the capital account, people worrying about capital outflows in China, in my view, the Chinese have got their capital account more under control, because they're now, ever since late last summer, they've been enforcing the rules much more tightly in terms of controlling capital outflow.
Coming back to India, you've said that the RBI Governor Raghuram Rajan getting an extension is important for the rupee and the currency remaining stable. Can you talk about your thoughts on the matter? Because a lot of articles appearing now that the extension is in sight. I mean, the date at least is in sight. What happens, what may not happen? What are your thoughts on the matter?
I'm assuming my base case is his term will be renewed, and that's the sense I get from my meetings. Obviously, no one can know this for sure, but that's the sense I get from my meetings in Bombay and Delhi in recent days. The second point is, but if I'm wrong and he is removed, I think there would be a negative impact on the currency and the bond market short term. Ironically, I think there might be a positive impact in the equity market, because many people think the RBI is being too tight from a monetary policy perspective. Now, the RBI, by global standards, has been extremely tight, but that is because the RBI governor is running the precise opposite policy of the G7 central banks. The Reserve Bank of India is targeting positive real interest rates to encourage savings and growth in financial assets. The G7 central banks are targeting negative interest rates. So in the long run, in my view, the RBI policy is fundamentally a sound policy, whereas the G7 policy is frankly crazy. So in the long run, I think this is a very constructive policy. I hope the RBI governor is maintained, but in the short term, if he's removed, it will be negative for the currency, negative for bonds, and positive for equities because people will assume the monetary policy is going to become more easy.
You know, you also in your latest report, Greed and Fear, write about the NPA problem which India is facing. Could you talk a little bit about that as well? I mean, do we have a complete sense of the problem now in terms of the existing stock of loans across banks at an aggregate level? Is most of that out in the open? And also some thoughts about how both the RBI and the government are dealing with it.
Well, I think actually that's the biggest single issue facing the government and the biggest single negative for the stock market. But I'm feeling a year ago when I was in India, I frankly was concerned that the government was not treating this issue with sufficient priority, because in my view they wasted at least a year in not addressing this issue more quickly, because the legacy NPL issue in the Indian banking system was already very clear at the last general election. There's probably at least 15% of loans in the system which are stressed in one form or other, could be more. Therefore, if you have a banking system where 15% of your loans are stressed, you don't need to be a rocket scientist to understand that that's going to constrain your economic growth. So a year ago, I was very concerned about this issue because we weren't seeing we weren't seeing the evidence the government was prioritizing it. But I think in the last year, we've seen more and more evidence that this issue is now front and center. And we've seen a number of developments. We've seen, I think the RBI has done an extremely good job in highlighting this issue, putting pressure on the banks to own up to problem loans, putting pressure on the banks to go after the borrowers. The RBI also carried out an important stress test to create focus on this issue. We've seen one or two interesting appointments at the top of public sector banks to get more private sector people involved. We now see the formation of this Bank Boards Bureau, which, although the exact shape of this Bank Boards Bureau is not 100% clear today, it's clear it's been formed to address this issue of NPAs. We've now seen the bankruptcy bill passed in the lower house and hopefully will pass in the upper house, which, in my view, is a very important reform. I think there's a huge opportunity building in distressed debt in India if all this goes ahead. So I'm feeling much more comfortable that this issue is now being addressed than I was 12 months ago, and that's one major reason why I'm retaining the overweight. But if I'm wrong and nothing happens here on this, if nothing happens on this NPA issue, then that's a big negative. And the other point, of course, we're now seeing much more focus on going after defaulting borrowers. And we also, my understanding is all the loans have been put on a common database. Makes it much more straightforward for the banks to see who owes what. So I think we're seeing some dramatic change in this area now in India.
Chris, you earlier said that one reason why we've not seen, and you don't expect big upsides in India this year, is because the private sector capex hasn't picked up. Just talk about that a little bit, and when do you see that happening, if at all, in 2016?
See, that's the problem. The private investment, it's hard for the private investment to recover let's put it like this, accelerate on a macro basis until we see more resolution on the NPA issue. It's sort of chicken and egg. So right now, we have clear evidence that the infrastructure spending is picking up, primarily driven by government spending, particularly in the roads area. But we also have growing reason to be optimistic in the power area because of the Uday scheme, and hopefully the sorting out of the long-standing problems in state electricity board distribution companies. So that's the good news. But from an overall macroeconomic investment cycle in terms of the corporate sector going on big round of investing, that's, in my view, clearly being held up by the NPA issue. And then the other problem, I suppose, on the investment side is, as far as I can tell, the residential property market still appears to be in the relative doldrums, although it's hard to get national data on that.